The Defending Your Finances YouTube channel is committed to giving you all of the tools necessary to help you understand how to manage your investments and your financial planning. Unfortunately, financial planning is portrayed to be a complicated and tedious endeavor, leaving few people willing to try to do it on their own. The truth, however, is that it's a simple process that anyone can do on their own when they're given the right tools and understanding. Subscribe to our channel and receive all of the tools you need to do all of your own financial planning and never have to pay or rely on someone else being intelligent enough or honest enough to do the right thing for you or those you care about. In this video, I'll explain the difference between a Roth IRA and a traditional IRA, and hopefully paint a picture that will allow you to always remember the difference between these two different retirement accounts. Now, the first step in setting up any investment or savings account is to define the purpose for saving and investing. If your purpose to save is for retirement, you've got two options basically to choose from: pre-tax and after-tax. Pre-tax means that the money is going into your investment account before it's taxed by the IRS. And consequently, after-tax means you've already paid taxes on the money that you're investing into your account. And for tax purposes, I want you to remember that a 401k and a traditional IRA are basically the same, as are a Roth 401k and a Roth IRA. So imagine you're going to plant some corn seeds and you're going to grow a field of corn. The vendor who sells you the seeds tells you that you have a choice as to how you're going to pay for them. Option 1, you can either pay for the seeds today and the entire harvest is yours to keep for free. Or option 2, you can take the seeds now at no charge, but when you harvest your crops, you'll have to pay the vendor at whatever the going rate is for those corn seeds at that time, based on your entire harvest. The kicker is that the fee will be based on the entire harvest. Any farmer will tell you that under normal circumstances, you're going to pay much more if your fee is based on your harvest. And again, under normal circumstances, you're going to be paying much less if your fee is going to be based on just paying for the seeds and allowing you to reap the entire harvest for free. The Roth 401k and the Roth IRA are equivalent to paying for the seeds today and reaping the entire harvest for free. Taxes are paid on the money you put into the Roth before it goes into the account, provided that the money is taken out at normal retirement age, which currently is defined by the IRS as age 59 and a half or later. This is the last tax you'll ever have to pay on this money. If you do a good job of investing and growing your money, you'll end up with a large harvest of assets that you'll never have to worry about paying taxes on ever again. The 401k or the traditional IRA is like getting the seeds for free today, but having to pay taxes on the entire harvest. The money that goes into your 401k or your traditional IRA is exempt from income taxes the year you put the money into the account. And let's assume you do a good job of investing and managing your money. The IRS is going to tax you on the entire harvest when you take the money out in retirement, again, currently defined as age 59 and a half or older. This means that you'll have to pay taxes on the money that you put into the account and all of the earnings that your account earned during the years you had the money invested. If you look at historic tax levels, we're currently sitting at one of the lowest tax brackets in history. So paying tax on the seeds today and reaping the entire harvest for free usually makes the most sense. We can define what that tax will be or that fee will be today on the money that you put into your accounts, but we cannot define what that tax or that fee will be in the future. So knowing that we're in one of the lowest tax brackets in history, it's probably pretty wise to pay taxes today and not having this giant question mark lingering over our heads as to what we're going to pay in the future, not just on our contributions, but on our contributions and our gains. Now, I want to encourage you to always contribute at least enough money to an employer retirement plan, like a 401k, to where you're maximizing your employer's match. Regardless of whether or not it's a Roth 401k or a traditional 401k, the match is free money that you should always be fighting to get your hands on. These days, most 401k plans have a Roth component, so check with your employer's plan and see if this is an option for you. All things being equal, there's only one set of circumstances that I can see a traditional IRA being a huge benefit over the Roth IRA. If you find yourself barely crossing the threshold into a higher tax bracket by less than $5,500, which I say $5,500 because currently the maximum IRA contribution for those under 50 years old is $5,500 and $6,500 for those 50 years old and older. So if you find yourself barely crossing the threshold into the higher tax bracket by less than $5,500, making a contribution to your traditional IRA will allow you to deduct that contribution from your taxable income, potentially sending you into the lower tax bracket. Here's an example. Let's take an unmarried individual that makes $40,000 during the 2018 tax year. According to these tax brackets, if this person makes $38,700 or more, they're in the 22% tax bracket. However, if this person makes a contribution of just $2,000, their taxable income will be reduced to $38,000, dropping this person into the 12% tax bracket. This would make sense since they'd be paying significantly less in income taxes. To see if this applies to you, reach out to the person who helps you file your taxes or otherwise figure out your total reportable income at the end of the year and check the tax tables to see how close you are to the tax bracket below you. Lastly, always remember that when it comes to a Roth and traditional IRA, you can make your contribution all the way up until the day you file your taxes in April of the following year. Traditionally, this is April 15th. I know in 2017 tax year, we had until, I think it was like April 18th to file our taxes, but traditionally, you have until April 15th to file, meaning theoretically you have until April 15th to make your contribution for the previous tax year. Determining what type of account to put your money in will determine how that money will be taxed either now or in the future, and it's critical to get this right because ultimately it determines how much of your money that you get to keep and how much you have to give to the IRS. For more information, email or visit our website in the video description below. I want to thank all of our loyal subscribers for all of your support. It's because of you that we're able to create this content and help people in defending their finances. If you're new to the channel, I want to thank you for taking the time to watch this video. This channel is all about providing you with the information you need to make great financial decisions and to try to help you to identify scams and frauds in the financial services industry. Now, we're here to help you. So click on the icon right here to subscribe and to be notified of future episodes. Also, don't forget to give this video a thumbs up and leave a comment in the comment section below, letting me know what you would like to see in future videos. Click here to see other videos and share them with friends and family that you think would benefit from knowing the behind-the-scenes truth about the financial services industry. For now, this is Dean with Defending Your Finances. Stick with me and I'll reveal to you the truth that few people know and almost nobody in the industry talks about. Thank you for watching, and God bless you and your families.